Hello and Happy New Year. I'm Steve Balt, the Director of Wealth Management and Financial Planning at Certa Financial Planning, here to give you our monthly update for January. The only change for this month in our macro stance is an upgrade to neutral for the Fed policy, due to the Fed signaling they're done hiking for this cycle. Our overall positioning for portfolios continues to be overweight growth and underweight tactical and alternative strategies as we participate in this current market uptrend. We're also neutral on preservation as money markets continue to pay north of 5%. These are the three questions we're currently monitoring. What happens after a 20% plus return? When will the Fed cut rates? And will a soft landing be achieved? The S&P 500 saw a 20+% return in 2023. What does that mean for 2024? Historically, after a 20% plus gain, the markets have been positive the following year for 80% of the time, with an average return of 10%. Only once, in 1997, was the return higher than the previous year. Additionally, 2024 is an election year. The previous 10 times we've had an election year under a first-term president, like we currently have under President Biden, the market has been positive. So far, we have followed the historical trend for a new president, a positive first year, a tough second year with midterm elections, and a strong positive pre-election year like we just went through. Time will tell if we continue this trend into 2024. Additionally, now it's been almost 2 years since the S&P hit an all-time high. The 14 previous times the market went at least a year without a new high and then finally made a new high, we were higher 13 of the 14 times, averaging almost 15% on those new year highs. However, one thing to keep in mind, the stock market also tends to reach an all-time high shortly before the start of recessions. We have not made an all-time high as of this video, but all-time highs are not always a sign of good things to come. The Fed signaled a pause in December, and the expectation is they will begin cutting in 2024. The Fed stated they expect 3 cuts starting in the second half of the year. The market expectations have come down in recent weeks, but the expectation is at least 6 cuts for a total of 150 basis points, double what the Fed has forecasted. This divergence will have a major impact on the markets in 2024. The recent market rally has been an anticipation of rate cuts. As those expectations have come down, we have seen interest rates start to rise slightly, and the market has gotten choppy. Now, one thing to keep in mind is that historically, Fed pauses have been positive and cause market rallies. Fed cuts have been bearish and typically coincide with a recession. Will a soft landing be achieved? Well, the majority view for 2024 is a soft landing is going to be achieved. Something we want you to remember, going into last year, the belief was a recession would happen. When everyone is in a consensus on something, that event tends not to happen. There was no recession in 2023, and the economy was extremely resilient, seeing large GDP growth in Q2 and Q3. The consensus being that a soft landing is going to happen is something we need to watch for 2024. Additionally, there's been a big spike in permanent job losses as of recently. Job losses have been accelerating, and the current rate of the increase is comparable to the dot-com, financial crisis, and pandemic. Historically, when we see an acceleration here, they tend to lead to a recession. Additionally, we have seen a divergence between job openings and the S&P 500. Historically, they have mirrored each other, with rising job openings signaling robust economic growth and optimism, which tends to drive the market higher. With this divergence, it's something we need to see if the market starts to turn downwards to track with job openings going down. Lastly, we want to remind you that even though an inverted yield curve on the 10-year and the 3-month typically precedes a recession, it does take time. The yield curve has now been inverted for a record number of days in a row, yet on average, recessions have begun 589 days after the curve first inverts. We're around 430 days. So we're not quite out of the woods yet, and there is a potential that in the next 3 to 6 months, the yield curve inversion we saw does lead to recession. Now, what does it all mean? Historically speaking, a 10% plus gain in November and December have been bullish for January, for quarter 1, as well as the following year. For now, the trend is up and our models have had us participating in the market run-up. We'll continue to follow our research and adjust accordingly. The signals we follow only tell us the trend and not how long it will last. As discussed, from the market standpoint, history is on our side. Presidential elections and years after strong gains tend to be positive. However, potential Fed cuts and a surprise hard landing could derail the historical trend. We'll continue to watch and update you as things change. As always, if you have any questions, please let us know. Thank you for watching, and we want to wish you a happy and healthy 2024.